So I'm joined by Alastair Mundy, who's a fund manager at Investec and manager of the Investec UK Special Situations Fund. So we asked you guys the questions that you wanted to put to fund managers. Alastair, let's kick things off. So first up, you're a value investor. It might be helpful if you could just quickly explain what value investing is for those that aren't in the know.
Yes, value investing is really buying the cheapest stocks, those with the most attractive valuations. The catch is there are usually attractive valuations for a reason. The stocks are typically beaten up. People don't think they've got a particularly great long-term future, or the company's got some sort of issue at the moment to deal with. So you're not getting something for nothing. You're getting something cheap with a perceived problem, and that's what value investing is really about.
So one of our customers quite brutally asked the question: is value investing dead?
Yeah, I think brutal but fair. Value investing has been a bad place to be for many investors around the world for the best part of a decade, and having been a brilliant place to be for the previous 100 years. So there's a number of reasons why value investing hasn't done very well. I don't necessarily believe all of them. I think it's sometimes when you write a 2,000-word essay, you've got to fill it up at the end. So I think the two major reasons why value investing has been poor, because inflation has been very low, which has really driven down bond yields, and bond yields are good for growth stocks, bad for value stocks, and also economic growth has been very low, which hasn't really provided much of a tailwind for these sorts of companies. So I think those two factors are coming to an end and therefore, if we start seeing bond yields pick up and economic growth, and I'm not saying real economic growth, just nominal economic growth, more economic activity, even if it's driven by inflation, I think they're to be two very positive factors for value. So I think value's resting rather than dead.
Okay, and so kind of one of the big factors that's affecting the economy at the moment is the ongoing Brexit talks.
Yeah.
So with the Brexit deal that Boris Johnson has on the table, what impact do you think that would have if it was carried through on markets and on value investing?
Yeah, I think like everyone else, we've got no idea what really the deal is going to be or mean. However, I think I'm working on the basis, first of all, I think if the deal does mean that there's going to be a slowdown or recession, I think the Conservatives will make sure, and the Bank of England will make sure they offset that as much as possible by pressing as many buttons and pulling as many levers as they can find. So it might be low interest rates, it might be more quantitative easing, stroke printing of money. It's clearly going to be more fiscal spending, building of prisons, roads, hospitals, whatever. And so I think that will act as an offset to the downside of Brexit. So perhaps I'm more positive than most on the outlook for UK companies, and there's a lot of value in UK companies because they've been beaten up. There's almost been a buyer's strike both globally and in the UK of stocks with a lot of UK domestic exposure because of all this uncertainty. And I think that's the big positive about Brexit. Many companies just want some level of certainty, and having had that, been provided with that, I think they're more likely to start investing and recruiting, etc. So just an end to the uncertainty on its own could be a big positive.
And on a more practical level of kind of running the fund, how do you acquire and dispose of large holdings in companies? So obviously a spotlight's been shone on this recently in some of the kind of Woodford scenario. So how do you go about doing that in a fund?
Well, typically we only invest in FTSE 350 stocks. We do very little in the small cap space. So that helps with liquidity. Secondly, we tend to tiptoe in and out of things. We don't suddenly have a huge volte face and buy into a huge position or sell a huge position on the portfolio. So that's also helps. And thirdly, because we're contrarians, when we do have a significant view, we tend to be buying when other people are selling and selling when other people are buying. So the market naturally offers us liquidity in the sort of stocks we're trading in.
And we've talked about the economy closer to home and kind of politics closer to home, but how worried are you about the threat of a global recession?
There's certainly a lot of reasons to be concerned about a global recession out there, and certainly in August everyone seemed to become global recession spotters. I think what interests me is more how the authorities react to recession. I think recessions have almost been outlawed by politicians and central banks, and therefore what's going to drive the market is their reaction. I think investors are almost too late to react to a recession. We've already seen those stocks that are most exposed to recessionary fears underperforming. So we would expect a a global slowdown or recession to be met by low interest rates, more QE and all that, etc. And we think that could be sort of result in more of a risk of an inflationary boom rather than a recessionary bust.
And so you've obviously been investing professionally for a long time, but for personal investors who are doing it themselves, what one single factor do you think is most important in a fund when you're picking funds?
I think the realisation that there's not one investment style that will always work. You know, we're always warned not. You know, that past performance isn't necessarily a guide to the future. But particularly if something has been very, very successful recently, I think there's a greater chance it's going to have a tough time in the future. So styles are inherently cyclical.
Excellent. Thanks a lot for joining us.
Thanks a lot.